Is the Dow 30 a good choice for an income bucket? Hey guys, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. So today we're looking at the Dow 30. Something different. It's not NASDAQ, it's not the S&P 500, it's not Russell. It's actually the Dow 30. So we're going to break it down today, find out if this is something that we're missing in our retirement income bucket. Is this something that could be a great satellite piece, or is it a core piece, or how would we use it accordingly? So grab your favorite mug, fill it with your favorite beverage, and sit back and let's learn about the Dow 30 today. Hey, if you don't have one, don't panic yet. The retirement made easy, living on dividends, coffee mugs, travel mugs, license plates. We are doing this stuff to support the channel, to keep doing the videos like we are, giving very professional answers to you, and we're basically staying unbiased. We're not taking advertisers. We're not doing anything different. We're just basically help support the channel with these select products. You can use the QR code. You can use the links down below in the description. Order them. Simple, easy to do. They ship out fairly quickly. And you can enjoy a beautiful mug in the morning with your dividends, living on life. So let's get into the rest of the video. So DJIA, it's the Global X Dow 30 Covered Call ETF. This is the fund we're talking about. It's an income generation. It uses the Dow 30 exposure, and it has a covered call premium income side of it. So we're collecting that premium for income. We're generating basic income from the funds, and we're staying invested in the long run. So the question retirees should be asking, does the Dow 30 belong inside a retirement income bucket? Well, DJIA gets less attention than the NASDAQ 100 and S&P 500 covered call funds, but it raises an important income planning question. And we're going to answer these is what does DJIA own? How does it cover calls work? What's the yield, the monthly cash flow, the growth, total return, which you know is very important to me, and how it handles the taxes. So realistically, income is only one part of the answer. We need all five to really make a good choice if this should be in our retirement package. So let's first off question is, what is DJIA? Well, it's a Dow 30 covered call ETF. Now the Dow 30 is the 30 blue chip US stocks price and weighted index and represents multiple parts of the US economy. Okay, so this is not going to be all just tech. This is not going to be just all finance. This is going to be a multifaceted area that they work with. Now, what they do in this ETF is they actually own the Dow Jones stocks. Okay, they're going to basically they own the actual stocks themselves. They're going to sell covered calls on an index and then use option premiums to support the monthly distributions. So they're going to have the stock basket of all the stocks that they own. They're going to do call option contracts on an index for that monthly cash flow. Anyone want to put their hands up and say, who does this sound like? This sounds exactly like the NEOS programs that does it for NASDAQ, S&P, and the Russell, and these guys are doing it with the Dow. So it's not the same as simply buying, DIA, which is the Dow, and collecting dividends. It's doing even more work. It's layering that call options on top of it all. So a different economical mix. So this is where we really break down the sectors. If you can look at this, and you'll see 27% of their portfolio is done in financials. Okay, that's good. Your banking side of things. They're going to be 17% industrials, 17% into information and technology, and 13% into healthcare. So you can see where this makes a major twist and a major difference between something like the NASDAQ 100. So the NASDAQ is heavily into technology, consumer services, consumer discretion, and other growth sectors, while the Dow 30 mix is financials, industrial, informational technology, healthcare. So you can see where they're really different. So this is why I thought this is a great piece, because it's stepping away from the overlapping of the NASDAQ and the overlapping of the S&P 500 to put us into a whole nother realm to work with. Now, the latest holdings and price weighing. Goldman Sachs is 11.7% of their portfolio. Caterpillar comes in at 9.4%. Microsoft comes in at 5.4%. So you can also see other names that they held: United Health, Travelers, Visa, JP Morgan. So, Goldman Sachs comes up a lot, especially on my channel, because we cover their ETFs so much, and them buying NEOS has come into play. So this is an interesting piece that I started looking at, that a lot of people are investing heavily into the Goldman Sachs side. So what they do is they price the price weighted versus equal weighted. So you can have higher price stocks and mid price stocks and low price stocks. And what they try to do is balance that across the board so everyone has an equal share across the game. So 30 stocks does not mean equal diversification. So, we're not going to take a certain percentage for every single stock. What we want to do is they start with the sectors, balance sectors out, and then balance out the sectors with select groups. That's why you'll see some with a higher number, because they have a higher price stock. They may have a little higher percentage across the board. So how DJI generates its income? Well, first off, it owns those Dow 30 stocks, okay? And you're going to collect some distributions and so on from that. Then what they do, they sell 1 month calls, okay? So it's approximately 1 month at the money calls that they put out there. They collect the premiums from that, and that supports the monthly distributions. So they do it in a very wide, I call it very, very target, as of doing a 1 month. So they're setting their price 1 month out. So that takes a lot of gamble out there. When I say gamble, that's someone looking 30 days out. What's going to happen in 30 days? Well, with today's markets and so on, it's tough to call that. But they have done this fairly well across the board. So the covered calls, income today with less upside tomorrow. The benefits of the covered calls, and a lot of us know this, but I'm just doing it deeper into this one, is the benefit of the current premium and cash flow. The option premium collected, the monthly cash flow potential, and the premium may soften those declines. Now, the covered call mechanism is own the Dow Jones stocks, sell those call options, receive the premiums, and limit your upside because you're doing call options. So the cost is really reducing the upside in strong rallies. And this is a common thing with covered calls. And people have to understand that's why we have the core and the satellite packages, because you may find one that's at better growth and you'll tie that in with something with better income, and it works accordingly. So the upside can be capped in strong rallies. You're going to miss out, and stocks still may fall. Even in strong rallies, you'll see some that will completely fall. So there is no free lunch in a covered call investing. But the 3 different yield numbers. First off, 1, the trailing past 12 months. And what this is just basically the past 12. So, wherever you start, we're starting at August 17th here. We're going all the way to August 17th of 2026 to give us a full 12-month period. And we've seen the distribution rate at 10.56. Now, this is a number that most people will use, is the 10.56. Very impressive number, fairly strong piece. The current yield, which basically now I'll call it year to date, okay, is 6.42%. So coming up to August, we're right on track to keep right in that 10% category. Now, the other one to look at is the SEC 30-day yield. What this number always tells you, which a lot of people ignore this number, but what this tells you is you take this 30-day yield, 0.97, and I'll make it easy for the video. I'm going to round it up to 1%. Remove that from the 12-month trailing yield. That means 9.56. That tells you that the fund itself, from its call options, is generating about 10 or 9.56%. Okay. 0.97% is being collected from distributions, interest, anything like that is coming in. So it's another way of them telling you how much the company has to deal with the call options versus what you get naturally. So you're going to see these numbers, big gaps between the two. Okay, so it's just a way of reading numbers across the board. So one, what's it done the past 12 months? That's past history that you can't guarantee on. Currently, what you've collected, and then how hard the machine has to really work. Now, the yield figure, what it means in dollars. In the past 12 months, you're getting about, on a $100,000 investment into this, you're getting roughly $10,560 per year, which is about $880 per month. Not bad. Now, currently, you would have collected $6,420 or $535 per month. So, it just gives you an idea of what the numbers look like from current distributions to total distributions. And I like to always watch the total because then you can plan out accordingly, but you keep track of it by the year to date. Now, growth matters. I've had this conversation. I said this now is my new saying, but I've had this conversation with people on our Patreon phone calls and so on. Growth doesn't matter. I'm in retirement. I don't want to grow anymore. I don't need any more money. You do, because there's a hidden tax called inflation. Okay? Your portfolio has to continue to grow to cover inflation, to make your buying power as strong as it once was. So with this here, high income only works if investment is also holding up over time. So your total return equals your price change and your distributions. So 1 year total return right now is 14.13%. 3 years are at 10.55, and since inception, which is 8.01. So since inception is basically February 2022. I had the numbers from June because I don't like to mix things up too much. And then this is why I said let's do this from the June side of it. So you can see that they have had a good 1 year. They're consistent in 3 years, and they're fairly consistent in a since inception, all with positive total return numbers. So what's the covered call trade-off look like? Well, when you own the index, okay, there's more upside participation, but still exposes you to the downside. So that trade-off is owning and writing calls. So the option premium today, which creates income, upside may be capped and the downside still is the stand risk. So if you just own it, you're really owning it for growth. So if you just said, I'll just buy the Dow Jones 30. Well, you're doing that to buy growth. Okay? When you're buying a fund like this, you're buying it to generate income with the potential of some growth. You're going to give up some growth to get the income. Now the tax treatment, because none of this means anything unless you keep the money in your pocket. So these guys use a unique type system. So the fund structure is this. It's a mixed straddle of accounting. Global X says it is a covered call fund, generally uses a mixed straddle approach for tax accounting. Now, because they're buying index, they actually qualify for Section 1256 options. And if you're not familiar with those, that means no matter how long you hold this, your distributions are coming to you 60% long-term, 40% short-term capital gains. Now, the dividend caveat. Because the holding period is suspension, dividends received by these covered call funds are generally not treated as qualified dividend income. Okay? So this whole thing changes a lot of your structure. So they use a lot of return of capital on top of that. So we got 1256 contracts. We have return of capital, again, following similar to what the NEOS program has always been doing. So what does ROC do? Well, I'll explain it real quickly again so people who don't understand this and don't know this, but ROC, return of capital, is basically what they're saying. They're returning your own capital back to you. What that does is reduce your cost basis of your investment. So until you get to either a zero or you sell the fund, the taxes are not, they're deferred all the way until you either erase it or you sell it. So that's a big factor. It's a good thing. So it doesn't count to you as income. So if you're getting close to, maybe you're getting close to Medicare, sorry about that, Medicare, or if you're getting close to that 2-year window for that, this is not counting towards your income. Now, there's a big thing I want to make sure people understand. In June 2026, the estimated ROC was 69.21%. Now, none of these numbers matter until you get your final 1099 DIV, because these things can change on a regular basis. Okay, but as of their last reporting that they were able to supply with us, they were given 69.21% ROC, which is common because they have the 1256 contracts. They have all pieces of it to have the tax programming. So 69, very impressive number. So here's a big thing, and I really want to get to is make sure people understand this. Why I always say that 1099 form is so critical. I went back and said, let's take a look at the 2025. Okay. So throughout the year, you're getting 19A, basically the fund estimates. They're called 19As. They come out, their fund estimates. We estimate we're 90%. We estimate we're 88%. We estimate we're 99%. Then the whole book can change at the end of the year when that 1099 DIV comes out. So let me show you here what's happened in 2025. They paid out approximately $2.33 distribution per share. Approximately 88% was ordinary dividends in short-term treatments. 12% came to you as long-term capital gain distributions. And in 2025, they used 0 ROC. So what did that mean? We paid 88% of that $2.33 we paid as ordinary short-term treatment. That means we paid the highest possible taxes on those dollars. So their tax program, to me, they're trying to copy NEOS, or maybe NEOS said they copied this with improvements. In 2025, they did not do what we would expect them to do. That 12% was the 1256 contracts for that long-term capital gain distribution, but why they did not use any ROC is beyond me. This is why I 100% tell you, you have to watch what happens on that 1099 DIV at the end of the year. Look at past histories of this stuff. Find out what the company has done. So this one here, I'm not excited about their tax side of it as a whole. So is DJIA a tax efficiency? Well, right now, looking on the surface, you got 1256 contracts, you got ROC. Normally, we would say sure. But the balance answer is not exceptionally simple or reliable tax efficiency. As I just showed you, they're all over the board. They didn't use any ROC, so cross off ROC on this list. They used 1256, but it was only 12%. That's not much at all. So you got to be careful with this one. So that's my warning to you that this one's probably not as tax efficient as we would want it. Excuse me. The expense ratio and the fund history. So expense ratio is 0.60%. Now, why do I bring this up? Well, this is a number. A lot of people question me. A lot of people bring different things to it and say, hey, Doug, you didn't talk about expenses. That means everything. Well, you got to remember that the expense ratio is there for only one reason. And that is to tell you how much money the issuer, the carrier, is charging to handle the expenses of the fund. So this means, and all the numbers I show you, all the total returns, the yields, always have this already pre-calculated into it. But What this tells you is for $10,000 invested, it's costing you $60. Okay? $60 to hold this for 12 months. That's the fee they charge. So what you want to do, sure, you want to have the lowest possible expense ratio because you're carrying it for a long period of time. But I've always said you do the along with this is if I'm paying 0.6, I better be getting more for my money than someone who's only 0.29 or 0.3. You better be performing better than the other side of it. So this one launched in February 23rd, 2022. So we're well over 4 years already into this fund. And their system seems to work. Their expense ratio, about normal for this type of area. But really, that expense ratio just means, are you going to carry it? It's going to cost you $60 for every 10,000 you invest. How well is it performing for you? Is there a better option with a lower expense if you're going to carry it for long periods of time? So does DJI belong in an income bucket? Well, potentially yes. But I really put it as a satellite income position, not a core issue. So why does it really fit? Well, it's got that monthly cash flow. It's got the blue chip Dow exposure, okay, which probably a lot of us don't have. It has a different mix than the NASDAQ and the S&P. And it's got a historical total return being very respectable. Why not a foundation? Well, A, because it's only 30 stocks. It's a price-weighted index, and at-the-money calls can substantially cap the upside. So the tax treatment is definitely more complicated and than the headline distributions implies. So I'd rather put this more as a income satellite, not a growth factor. If you do the way I follow my income buckets, I have a NASDAQ category, an S&P 500, a Russell category, an international category, and then I have I haven't really a great name for it because it does change because I may throw REITs in it, I may throw energy into it, but I call my collect all bucket at the end. And this one here, if I put it in as a Dow 30, yeah, it's going to be a smaller, maybe 5%, 10% max piece of it. But really, I like putting it into the cover call because of that 10%. Basically, I look at it as it's a nice booster across the board. So the 3-bucket retirement system, the best fit, of course, is going to be in the income bucket. It's not a foundation piece. I want to make sure people understand that. It's not a foundation. Foundation's your cash, your treasury bills, your short-term bonds. The other one is the growth bucket, okay? Is the growth bucket across the board. And that one is, it's for long-term pure assets. This is not designed for that. This is designed as a satellite, and I completely say satellite, in your income bucket. So using my scorecard, as for income, I think it's a very good package. That near 10% trailing distributions looks very strong. It's not going to be record total numbers out there. It's not going to be, wow, this is the biggest income one. But it gives you another solid piece to build off of. The growth, it has some average good growth, built-in income with the upside potential, and good so far total returns. I like what I'm seeing here. You're not going to have huge growth. You're not going to have big income. You have a good balance between the two. Diversification, it's diversified because it's different from NASDAQ and the S&P, but it still only holds 30 price weighted stock. So I wouldn't give it a big 2 thumbs up on diversification, but I will give the big thumbs up because it's different from your NASDAQ and your S&P. So it's another way to diversify your portfolio. And tax efficiency, I'm still mixed on this one. I don't like what they did in 2025. I don't even know if I'm true fact of 2026 of what they're telling me. So I really got to watch this one all, very hard with it. Now, if you're in a 401k or if you're into something like that, a Roth, it doesn't really matter anymore. But it's when you're in your brokerage fund, which a lot of retirees have this stuff in brokerage funds across the board. So final verdict, I think it does qualify. I do think it qualifies. I do like it in an income portfolio bucket. I do think it has a long-term appreciation. It's going to be capped. But I think it's one of these pieces that you definitely, if you're using it as a satellite, it's a thumbs up from Doug. If you're using a portfolio, for cash flow, and it's not a personalized, I won't recommend nothing. I mean, it's part of the rules. I do not personalize recommend anything, but I put it to you as, this fits into the 3 bucket system. So let me know your thoughts. What do you think about this? Does it fit in the portfolio or not? So in closing, the yield gets attention. Total return tells you everything about an investment if it's actually working. Taxes determine how much of the paycheck we get to keep. So you really got to make sure you check every one of the boxes before you jump into it. Guys, I'm Doug the Retirement Guy. Thank you for watching. If you have a comment, leave it down below. If you like my opinion onto it, great. If you don't, please leave a comment down below. Love to hear from you all. And don't forget, we still have those coffee mugs. The links are down below. We'll see you at the next video.